program here? Is this the one on outer space videotaping and asteroids?
No, I don't think that's the same one.
Okay. Is this the one on reverse triangular mergers for acquisitions?
Well, that was last week.
Got it. All right. Is this the one on S corporation basis deductions and some sort of form I'm supposed to fill out if I want to take my deduction?
Something like that.
Okay. Here, let's hand this over to Alan. Hey. It is time. It is time to explore the world of S corporation basis and reporting to the IRS, and introducing you to my new friend and a very accomplished tax lawyer, Bradley Burnett, who fortunately knows all about this because I forgot it all, if I never knew it. So Bradley, welcome. And you've got the slides. And the first one looks pretty intimidating. Is that like a bunch of CPAs cooking that they're getting boiled before the end of the tax year?
I think that's all the ghosts of past S corp basis that was never computed properly.
Gosh, there it is. So Bradley, what is this all about?
Well, IRS was getting a little bit tired of nobody keeping track of their basis, and so IRS got a little cranky and made up a new form that we have to attach sometimes. And now everybody's caught like a deer in the headlights. So let's take a look here. If I could only move the slides like I could before we started. Oh, here we go. Okay. So my pleasure to be here on the same program with Alan Gassman. I learned from him continuously, and that's really incredible. And thank you for that, Alan. Thanks for the pleasure of being with you today. I practiced law in Denver, Colorado, and have been doing so for about 39 years. And my mother wrote my resume. I have no idea how much of it's true. So let's just move on. Let's gather around this rather pronounced campfire for a story. S corps were invented by Congress in 1958, and the notion is income and losses flow through from the S corp to the shareholder. Losses flow through, but there's a limit, only to the extent of basis in the shareholder's stock and debt. Now, by contrast, you see losses can come through if you have either basis in your stock and or debt, but distributions are only tax-free to the extent of basis in your stock. If you don't have basis in stock, there's a resulting capital gain. And so shareholders were running amok, not computing their basis, nor was the S corp computing the basis. No one was computing the basis, not well at least, but it's the shareholder's responsibility, not the S corp's. And in 2018, IRS introduced a form, a basis worksheet in the 1120 SK1 instructions, and said all shareholders need to attach it to their 1040s when they take a loss or have a distribution or sell their stock or something. The problem is nobody did that. Nobody took it seriously. It was a PDF, and IRS couldn't track it, so they couldn't enforce the rules. So IRS said, enough of that. Brand spanking new form 7203. And by the way, there is no equivalent form for partnerships, interestingly. This is just for S corp shareholders. There are loss limitation rules like jumping over hurdles. So imagine before the track meet, she goes to the coach and says, hey coach, how many hurdles do I have to jump today in the race? And the coach goes, hey kid, 6. If you have a loss in your business and you want to deduct the loss, you must jump over these 6 hurdles. This is the order in which they show up on the track. 5 of them are shareholder level loss limits. Unlike 163J, the limit on business interest expense, which is at the corporate level. But of the shareholder level loss limits, stock basis and debt basis, are the first. If you don't jump over this, if you run up to it and, hey, coach, I can't jump, well, then you're stuck behind it and you can't take your loss. This one comes first, and then at-risk, passive, and all those other silly things happen later. The new Form 7203 tracks this hurdle and whether we have enough moxie to jump over it. So, dun-da-dum, announcing Form 7203, which is brand spanking new as of this past December. Here's at least what the top part of it looks like. It starts out with shareholder stock basis. And we're going to break this down for you today. What's this form do? It's a glorified basis worksheet. It tracks shareholder basis and stock and debt. It also measures how much loss you can take, how much is disallowed, how much carries forward. It replaces the old worksheet that nobody even thought about, let alone complied with. Well, so here's the deal. You go to your computer software as an S Corp shareholder, and by that I mean 1040 preparer or a 1041 preparer, because we all know that individuals, trusts, and estates can own S Corp stock, certain trusts. Well, all that said, if you have one of four things that happened in connection with that S Corp as a shareholder, then you must attach the 7203. And this is where America's a deer in the headlights on this thing, because your software won't let you file unless you attach the 7203.
Wow.
Any one of these four conditions stop the train. First of all, claim operational loss, including a carryover. So Alan, if somebody had a carryover something from a prior year that was held up by the basis limitation, that forces the 7203 this year. Receiving a non-dividend distribution, sale of stock, or repayment by a corporation of a loan from a shareholder. Any one of these, you're in the soup for the 7203. Interesting IRS practice considerations on this thing. So first, why did IRS introduce the form? Well, they were sick and tired of nobody playing by the rules. IRS is now enabled to capture, analyze the data, to disallow losses, to assert income tax on distributions. And it also, and this is my opinion, this is from the My Opinion department, appears to permit iOS some poetic license to take aggressive positions against us in their so-called instructions to Form 7203. Yet those positions are not supported even in IRS's own regs or website. So we're going to expose a couple of those for you today. Well, what does IRS look at in S Corp exams? Well, they look at basis, AAA accounts. They look at if there's C Corp E&P, it's ordinary income, and they look at it maybe terminate your S election if you have 3 years of so-called passive income under 1362 and undistributed C Corp E&P. They also look at employment tax. Interestingly, if they assert employment tax, it reduces basis either way, whether it's that or distribution. So it doesn't affect our topic much today. All of that said, it is the shareholder's job to compute basis and report it, and not the S Corp's job. Now, what are the time estimates? This one's good for a laugh. Anyway, IRS says, learning about the law.
15 minutes. Giving you a full 30, so you have twice as much time as you need, Brad.
Oh, thanks.
That's very unusual, isn't it? 15 minutes. I mean, do you think that was just an error? Because
I think they're serious about it. I mean, this form went through notice and comment. I mean, they didn't change that. So I don't know. At last count, I've got 70 plus hours into this topic, and I think I can get to the point where I can tread water, but there's a lot to it. So how do you fill out the 7203 if you're this shareholder that's an individual, estate, or trust? Well, the big thing is you have to have your feet on the ground first, and that could be helpful. If you ever did fill out the old worksheet, you can use those numbers. But if you have a new client or a client that supplied their own basis number, don't even begin to think that you can use that number, as we're about to show you. Now, the operational data is pulled from the K1s. This seems like an ominous thing, this 7203. The operational data is pulled from the K1s. So if you have an old stack of K1s sitting out there that are accurately prepared, you're in pretty good shape. But Alan, here's something that makes life an adventure for our accountant friends. Reports are that the tax software companies, the various ones, are all over the place with this form, and that the various answers are spewed all over the place, and that's an adventure in and of itself. We cannot, at least in the early going on this form, trust what the tax software company said. Now, one of the issues is the only way to really know the number is to prepare your own spreadsheet. We're going to show you how to do that today. But interestingly, the form 7203 is not linear, so you have to have hopefully a son or daughter or a college kid that's, you know, good at computers that can build that spreadsheet, because numbers from part 3 of the form are pulled back into parts 1 and 2, or you can't go forward with 1 and 2, and you can just imagine that. But every 7203 is a face page for a basis spreadsheet, and we have to have all these separate spreadsheets, but the 7203 is just the face page. In fact, imagine this: separate 7203s for each S Corp the shareholder owns a piece of, for each block of stock in each such S Corp, for each spouse, and if there's been part of the stock redeemed, a separate 7203 for each block, those retained and those disposed of. And remember, there is and Alan, here's a question. I don't know if you've ever done much on community property law, but you know, it can find its way to us in non-community property states. Do you have to fill out a separate 7203 for spouses in the community property state? And interestingly, IRS didn't answer that. And I've been tossing and turning at night contemplating that. I don't think so. I think it's the same block of stock, but it's just treated as owned by two people for income tax purposes. But I think if the spouses ever split, you'd have to split it out if they split the stock out. But I think it's just one block of stock. Anyway, that's one of the deep philosophical questions in life. So let's look at this S Corp stock and debt basis. And first, why does a shareholder need basis? Well, to prove that distributions are not taxable, to allow losses to pass through, and to reduce gain or increase loss upon sale. Basis is an ongoing number for each block and for each piece of debt. Basis cannot go negative. Instead of going negative, like a capital account in a partnership could, instead of going negative for a S Corp shareholder, distributions are instead treated as gain on the sale of stock, and that's net capital gain, depending on your holding period. Now, this slide right here is the punchline. If you get this down, then you'll have your bearings as you go on through the forest. Here we go. Losses deductions can pass through to the shareholder to the extent of both the shareholder stock basis and debt basis. However, non-dividend distributions are non-taxable only to the extent of stock basis. So you can imagine the drama that accompanies that distinction. So let's look at these basis formulas. Here's the stock basis formula. And then here's the debt basis formula. But you always have to start out with an initial balance with integrity. And so let's first start out with our stock basis. We start out with our initial investment. Interestingly, Alan, the courts call this investment. We call it basis, we tax geeks, but the court says, what's your investment? It's out of pocket what you started with, or it's the property you traded for stock, plus additional capital contributions. In the basis rules, capital contributions are treated the same as if you bought a piece of stock. And then plus income, minus distributions, minus losses, and so it goes. So here's the form. Part 1 is stock basis that you started with, plus income. And there's the bottom part of part 1, because it all doesn't fit on one PowerPoint slide. Then you have to jump to part 3, and part 3 computes your losses, and then that line 47 loss number goes back to part 1, which is an adventure for a nonlinear thinker. Now let's do an example here. Sailor Jerry is the sole shareholder of Spice Rum Incorporated, and the beginning stock basis is $5,000. A non-dividend distribution 4,000. That comes first in the ordering rules. The remaining basis after distribution is 1,000. If this year we had a out-of-pocket loss of 10, 1,000 would be allowed because that's all the stock basis we have left. In this example, we're ignoring debt basis just to keep it easy. We're going to have a 9,000 carry forward loss. So basis is the showstopper. I hope everybody can see this, but here's the form, and it's just what we just said. You start with 5, you subtract the 4 of distribution, you've got 1,000 basis. You can take your loss of 1,000 to that extent. Your end of the year stock basis is 0. And then we go to part 3, and this is the one that pipes in the carryovers in column B. Here we had no carryovers to keep it simple. You were allowed 1,000 of loss, but the 9 carries over to the next year. And how long does that carry over if it's disallowed by the basis rule? And the answer is forever. And it looks like a trap, doesn't it? The fact that the distributions reduce stock basis first, and therefore the losses are disallowed. But let's think about this for a second. Is that so horrible a trap? Alan, which would your client rather have? Would they rather have cash at 100% benefit, cash from the till at the company, or would they rather have a 30 to 45% benefit as a tax loss? Looks to me like they'd rather have the whole dollar. I mean, I'm not sure this is such a horrible thing. It's just that if you end up with an income tax bill, it won't seem so fun. And we'll come back to that in a second. Well, so here we go. This is part 3. It's the one we just looked at. That's fair enough. And so now, Alan, I'm going to ask you a question. Did you always think that a promissory note was a capital asset, just off the cuff?
No, you don't think of it that way.
But what if I sold it?
And it would sound like a capital asset.
And I don't know if IRS is a little confused or not, but IRS is saying a couple things. They're saying that, well, I'll come back to that point in a second, but how about this one? Should you be able to net your carryover loss? Let's say we have a $15,000 carryover loss that rolls into Spice Drum Inc. Should we be able to use that first, offset against this year's ordinary income, or should it sit there and be limited and reduced by distributions first? Now that's an interesting question. So let's see how that one's going to play out here in a second. IRS and its form 7203, and I think that IRS is taking poetic license with this form to push more income tax on us currently. Take a look at this example, and I don't think they're right because they're disagreeing with their own regs. If in 2021 there was an $800 ordinary income on the K1 and a $600 distribution, under IRS's approach, this would give you $200 worth of basis so you could soak up a loss against it. But then again, if you look over on the right-hand column, the regulations approach, if you could use a carryover loss against it of 400 first, then you go figure your distribution, at which point then there would be a $200 income, but that would be a capital gain instead of ordinary income. And if you look down at the bottom of the slide, what you'll see is that there's more tax under the IRS form approach because there's a mix of ordinary income and capital gain. On the right-hand side, it's all capital gain. And so I got to scratching my head over that one because, again, I did my spreadsheet first, and then I went and looked at what my tax software said, and it wanted more money. And I thought, why? And then I went back and looked at the regulations, and the regulations actually, I think, give you a lower tax bill. And here are those reg sites, which basically say that that carryover loss should net out against the current year income before they get limited by current year's distributions. So that's a little fishy, Alan, I think. Now, there's all these methods of acquiring stock, and that's great. And I show you historically how you get basis for those. But we only have a half hour today, so I just put that in the materials for your reference. You have to have a good starting number. I want to show you some more interesting things from a current perspective. The first one is there's this brand new Schedule K2 and K3 that set the tax world on fire. It's got to do with reporting international activity. The K2 is an extension of the Schedule K. The K3 is an extension of the K1 for international activity. Now, there's an interesting thing going on, because if this pass-through entity paid some foreign tax, then and this is counterintuitive, you enter it twice into the software, once into the K and K1, because that's the part that reduces the shareholders' basis in their S-Corp stock. You enter it a second time in the K2, K3 so they can figure their foreign tax credit. Now, you think you're double counting when you do that, but you're not. It's just the way IRS wants us to set it up. So that's an interesting thing. Now, while we're tracking all this basis, please everybody remember that when you go to sell stock, that you can specifically ID the exact shares that you desire to be sold. And that's an interesting thing. If you want to minimize gain, allocate to high basis shares. If you want to soak up suspended losses, allocate to low basis shares. If you want to split the difference, prorate the sale between the two blocks of stock, which is the general rule. So here we have JoJo, who's a 100% shareholder in Get Back Inc. He bought 50 shares in 1970 when they released the song Get Back for $50,000. And then in 2020, he inherited from Paul, who sadly passed, and has a 200,000 basis. So he has two blocks of stock. One has a higher basis, one has a lower basis. In 2021, JoJo desires to sell 30 shares to Sweet Loretta Martin. And so here's the question. How do we choose the shares of the basis that are sold? Well, JoJo has three choices. And if he wants less gain, allocate to the high basis shares that he inherited. If he wants to soak up suspended losses, allocate to the low basis shares. If he wants to split the difference, the general rule that you'll get if you don't specially identify the shares sold is going to be, there's going to be a proration based on the adjusted basis of each block of stock. Okay, now we get into debt basis here, and I want to hit the most interesting things. I've got a whole bunch of court cases that talk about how to get debt basis, how not to get debt basis, and I leave those for your good reading. But here's an interesting thing. First of all, a formal note you and I know as a promissory note that Allen's law office drafted up. That's great. But now look right below that. Open account debt. And the IRS tells us in their regs and in these instructions to the 7203 that anytime an open account debt reaches a $25,000 balance or more, that the following year it will be treated as a formal note and must be separately tracked. And then when you're filling out that 7203, you have to check the note box, even though it's just some loan suspense account. Now that's an interesting thing, and you might ask, well, why is IRS so worried about that? Well, for starters, they want to formalize it so they can make rules about it. And if you look here, there's a section C of part 2 of the 7203 that says gain on loan repayment. I'm going to show you an example of how this works, but IRS is out hunting and pecking for raising taxes off this deal. Now remember that if the shareholder is paid off by the S Corp, it's going to be non-taxable to the extent of recovery of basis and debt, but taxable to the extent the repayment by the Corp exceeds the basis and debt. So here's an example where Becky is paid back by the S Corp for the full face amount of the note of 50. The problem is Becky's basis in her note is only 40. How'd that happen? Well, Becky took losses last year of 10,000, which reduced as those passed through, and she enjoyed them on her 1040, they reduced the basis in her note. So now when the Corp pays back the principal of 50, the face of the debt, what happens? She has $10,000 income on the seller exchange of that note. Now, Alan, that's why I asked you, what if you thought, I think a promissory note is a capital asset. If I were to have one, somebody owed me money and I went to sell it, you would produce capital gain or loss. Look at what IRS is up to here in these instructions. they're saying that an open account debt, when it hits 25,000 or more, is going to be treated as a promissory note. And they go on, they have the chutzpah to go on to say that, oh, by the way, when there's that recapture we just saw in the prior slide, the income resulting from the repayment by the S Corp to the shareholder, it's ordinary income. Now, where did they come up with that? It just seems to me that they're dead wrong, but yet that's what the instructions say. But I don't see that in the regs any place. And so if it's just the instructions, do I have to attach an 8275 if I go against it? Now, remember that the software is all over the place, as is usual when there's something new about this. We have to let the software settle in and find its niche and all that. But the thing is I got to watch out for ordinary income. I just can't let the software do that to me. I don't think it's right. Who knows? We'll get more time to think about this. Now, class, golly, there's some stuff I want to skip because there's stuff I want to get to. But if here's the deal, I'm skipping over the burden of proof stuff. But I want you to know about that is, if you don't prove your own basis, nobody's going to do it for you. And so I show you some cases where there's controversy about that. In fact, I'll show you a case here where this Salem case, where ultimately the accuracy penalty was asserted because the shareholder didn't keep track of their basis. So the whole thing about, do you get basis in merely guaranteeing an S Corp debt? We all know that you do not. But if you do guarantee, and if you look at the last case here, Franklin, you'll see that in that case, the creditor got a little rambunctious and seized and sold the property of the shareholder who guaranteed the debt, and the sales price of, if you will, the foreclosure sales price ended up adding debt to the basis. And so back-to-back loans, and that's where the shareholder borrows money from the bank and turns around and loans it to the S Corp. It's fine if it's done properly. But here's what doesn't work is a circular loan, where the flow of the funds creates loans between the parties with the cash beginning and ending with the original lender. There's no outside money being pumped in. That doesn't work. And I have the landmark seminal case, Oren, which proves that, but I'm not going to take our time for that. I've got some other things. Remember that you have to have economic outline. So down Allen's Way, because I'm out in Colorado out here, there was a real estate developer that had splinter companies all over the place, that had splinter loans all over the place. And at the end of the year, all these, if you will, related satellite companies, and who pays the bills in the real world? It's the company that has the money in the checkbook. That's the way it goes. And so here, all these companies are paying each other's bills if they happen to have money that day. Well, here we have a gentleman, a Miami, Florida real estate developer, Homero Mirello, and his companies were already bailing each other out right and left. And these splinter loans went all over the place to the tune of $15 million. And he said, oh, everybody knows, since my accountant drafted up a promissory note that said it was really my loan to the company when my S Corps and LLCs lent money to each other. And the court says, we don't buy it because there's no evidence of advances by you, no economic outlay, and no evidence of the debt from these entities back to you. The problem is it was debt between the affiliates, not between the shareholders. Well, that ended up costing our friend about $2.6 million in tax. And so don't be caught in those offsetting accounting entries. Here's some key factors on determining basically who indeed is the actual borrower and lender. We have a few minutes left. Here we go. Is this taxpayer was successful? They had a smart accountant who had a good idea. Donald owned 25% of a casino in Las Vegas. The bank lent the money to the S Corp. That's the wrong way to do it. You don't get basis for that. They went to the bank and said, tear up that note. We'll give you our personal notes. The bank swapped them straight across because the bank thought they were the better credit risk than the S Corp anyway. And the tax court said that worked. And I haven't seen a case that's overturned that. Anyway, the tax court used an old revenue ruling against the IRS and turned it right back against them as the basis for the ruling. And then here's a case that walks the line. So interestingly, this is a cattleman out of Central Texas, Dennis Bolding, and he borrowed from the bank $250,000 to get a line of credit to buy cattle. Okay, now, Alan, this will interest you as an attorney. If you look at number 4, the note and security agreement said Dennis, the human being, is borrowing DBA Three Forks Land and Cattle, which is the S corp. Now that's messed up because an individual doesn't DBA as an S corp. You're either an individual or an S corp. So you can see that this is messy. And basically, when he borrowed the money personally, and then he went to the teller window at the little Texas bank, and they cut the check straight to the S corp, which wrote a check for the cattle. And the IRS said that doesn't give you basis because it's not a back-to-back loan. It wasn't a loan to you, then you loaned it to the S corp. The tax court said that's right. It was too messed up because the paperwork didn't have integrity. The burden of proof's on you. Interesting though, that after the tax court after the tax court ruled against him, that the Court of Appeals 5 that sits in Dallas actually said that we buy this. This works just fine. First of all, Alan, interestingly here, the DBA designation, while it's not the cleanest thing in the world, is just a distractor. It's not controlling because he really borrowed the money. And interestingly, when the little lady at the teller window at the bank cut the check to the S corp, the bank said, good enough for us. I mean, pardon me, the Fifth Circuit said, we're going to count that as a capital contribution. And so the key was he borrowed the money. And so even when the bank messed up and put it in the corporation's account, the draw on his line of credit, well, the Fifth Circuit says, we know what you meant. Now, you would never, ever, ever plan to do it this way. But if you're caught in trouble, then you want to know about the Bolding case because the Court of Appeals 5 forgave it. So Johnny Cash would sing this, I walk the line. But you know, they could add another verse to that song in honor of the Bolding case that goes something like this. The fact pattern was not as clean as we would like, but it's clean enough. After the dust settled, the deposits by the bank into the S corp account were treated as a loan by a shareholder to his corp. Now, you don't want to do that. Now, Alan, I recognize the time here. And can I have a minute or two to cover a couple things that I think we should to be responsible? All right, thanks. So back-to-back loans work just fine. And there's a point here that the courts like it when you list debt on the balance sheet. Even though if you don't have to file the balance sheet, it's a good move to do it. Your audit rate drops, there's proof of that. These are the accountants. For our accounting friends in the audience, these 4 things you have to have if you want to approve back-to-back loans. If you don't have these 4 practices in place, kiss it goodbye. When a shareholder contributes his own promissory note to the corporation, that gives you no basis. That doesn't work. And so, what about restoration of debt basis? If a loss is allowed against the face of your debt, it drops the basis, but it can be restored by basically income or other things. So if there's income in a future period, first of all, debt basis is restored, and then stock basis is later restored. So I show you the mechanics of that. We'll talk about distributions here. Here's the pecking order. And when you run out of basis, there's capital gain treatment. 2 quick things. This guy's out of Miami, Florida as well. And Michael Kelly, and he's a high roller. He bought an $11.2 million house at Miami Beach, and he married a supermodel, and so it goes. But when the Great Recession hit, he couldn't make his payments. Well, he'd been taking money out of his S corp a lot, like $43 million. And he called it a promissory note. That supported his high lifestyle. And so then he goes to distribute the note and he says, hey, since I'm busted broke because of the Great Recession, the only tax on the distribution of that note is the much lower fair market value. What the tax court say? That's not how it works, brother. If you're going to dance, you got to pay the piper. It's the face amount of your note, regardless of its fair market value. That's the distribution. And then they said, besides that, if you keep taking money out and calling it a loan, at the moment you become insolvent, then after that point, it's going to be a capital gain on a distribution of cash. We'll believe that the corporation can loan to you so long as you're solvent, but the moment you become insolvent, forget about it. It's a distribution that's taxable. Now, I got one last point, Alan, and I thought that was an interesting case. And so I'm going to move on here to, how do you pull rabbits out of hats? Well, here's the question. Can you reconstruct bases? You know, we told you you could go back and look at the K1s, take the operational items, but what if there's just some chunk of bases out there and the records are missing in action? And here's a question. Would you feel comfortable reconstructing basis under the Cohan rule? We all know that Mr. Cohan won a court case where he didn't have very good records, but he had some high integrity, indirect proof of sorts. And so based on his testimony and a few scraps of backup proof that would approximate what he was trying to prove, they gave it to him, the Cohan rule. It's a reconstruction doctrine. Now, here's an interesting case. I love this case with every ounce of me. Andrew Shank is a Wall Street banker. He put money in his IRA, and 20 years went by. He didn't keep his Form 8606 on his IRA, so he couldn't prove the basis. So IRS says, look, if you can't prove your basis, it's zero. And he goes, no, that's not true. Here's an old scrap of paper from Citibank that shows I invested $4,760 in my IRA 20 years ago. And he says, my oral testimony on the witness stand is I was a high income earner and therefore would have not got to deduct my IRA. Therefore, I have basis to this extent. And I got more than that. It's just, this is the only piece of paper I can find. So what the tax court said, they said, brother, we'll give you basis every day of the week. If you show us a scrap of paper like that, we'll give you $4,760 in basis. Now, Alan, here's my point. That's why I love the case so much. This guy proved basis when he couldn't prove basis, but the court allowed Cohan. Isn't that the greatest thing on the planet? So now, what if we're caught in this position? What if somebody listening to this program says, I know there was a chunk of capital went in that company, but I just can't find the record of it. They shredded it, or it burned down in a fire or something. Couldn't you use Cohan? And I'm going to say, if it worked for Andrew Shank with the IRA basis, for crying out loud, it should work for S-Corp basis. And I would recommend anytime you use Cohan to reconstruct something that you attach the Form 8275. Okay, there's one last point, and Alan thinks I'm going to one last point him to death, but here we go. Here it is. And it's got to do with PPP, and I'd be negligent not to cover this. So here's the deal. IRS came out with a RevProc-48 last Thanksgiving, and they said, look, we all know that you don't get your basis step up in an S corporate partnership from forgiveness of PPP loan, tax exempt income, until the SBA reimburses the bank and signs off on the debt relief. But here comes IRS in a moment of extraordinary generosity to the taxpayer, and they said, here's what we're going to do. We're going to give you a safe harbor. Quick fact pattern. You got the PPP money, spent it in 2020. You got the forgiveness applied for in 21. You got the forgiveness in 22. That's a typical fact pattern. IRS in the RevProc says, make you a deal. You can put the tax exempt income from PPP debt relief in any one of those years that you want to. Now, why would IRS be so nice? Bottom line. They probably realize that everything's so messed up out there. They're like, what a mess. Let's just leave it lie where it is. That's my guess. But Alan, here's the interesting part. That is, if you want to move it to somewhere else, they're going to let you, so long as you file an amended return. That means RevProc-48, we're like a kid in a candy store. Look at this big batch of M&Ms. This couldn't be better, because if we want to move this with an amended return to a year where there's a higher income tax rate, and if it frees up deductions to offset there, that's the cat's meow. It saves us money. Or if we want to place it in a year, one of those 3 years we talked about, to free up an NOL deduction for the carryover, that may be indeed all the better. And so this fantastic new RevProc layers on top of what we talked about today, and of course would be reported on the 7203 as tax exempt income on part 1. Okay, Alan, and this also works for the basis step up, restaurant revitalization grants, shuttered venue grants, and subsidized payment by the government of certain principal, interest, and fees. Okay, that's it.
Well, Bradley, that was excellent. We had a lot of attendees. They all enjoyed it. I enjoyed it. I learned a lot of new stuff. What are you going to bring back to us for the next presentation?
Gosh, if anybody cared, I'd say K2, K3s on international, but nobody wants that probably.
Oh, actually, we've had 2 people ask about K2, K3s on the international, including Angie and China. So if you want to just schedule that, let us know, and we really appreciate it.
Happy to do it.
All right, everybody. And Bradley, what's your email address for questions?
Bradley@bradleyburnett.com.
Yeah, or email me and I'll forward it to Bradley. Well, thank you very much. I learned a lot. That was a great presentation. I hope you give it often.
Thanks, Alan. Thanks for having me.
All right. Take care.